Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo. And on today's episode, we're going to be talking about what the Fed rate cut that just occurred means for you. If you haven't heard, last week, the Fed came out and they cut interest rates by 0.5%, which was good news to some, maybe not so good news to others, depending on what your viewpoint is on that. When it comes to interest rates, it affects borrowing and it affects the return on our cash. And so when we're looking at this, we want to analyze it from the standpoint of how is it affecting you over the long haul. We don't want to look at this in short term because interest rates change, right? They've been changing throughout history. And so we're going to talk about how the interest rates affects the short-term version, but we're also going to talk about what you should be doing in terms of building your financial plan so that interest rates don't make or break your plan. So let's dive right in. So as I mentioned, the Fed rate cut it by 0.5%. What this really does on the borrowing side of stuff is it lowers the cost to borrow, right? Credit card interest rates, mortgages, in theory, should come down. Now, one note around this, especially when it comes to real estate or just all of it, is look, we're living in a time where news comes out and it's instantaneous, meaning the interest rates and everything, the mortgage rates that are out there was already building in the rate cut. So it's not something, while it still might lower mortgage rates, for example, it may not lower like tomorrow or even in the next 6 months. It might lower over the next couple years. It is not instantaneous. And I think that's a big misunderstanding. People get all excited about, oh, rate cuts are occurring. It's in the right direction from a standpoint of lowering interest rates on debt, but it doesn't happen instantaneous because, again, the way the market was already going, the market was up because it already had taken into account that the expectations were the Fed was going to lower the interest rate. So that's number one. The bad thing about this is, all the rage over the last couple of years has been these high yield savings accounts. Well, when you lower the interest rates, the high yield savings accounts and the CDs, those are also going to lower typically. And so while it's cheaper to borrow, it's also cheaper or lower interest rate on the cash that you're sitting on. Now, I want to be clear about this. I'm not suggesting that you go move that cash and invest it in the stock market. I'm just sharing how this works. So why is this important? Well, why this is important is if you look over the history of the interest rates, like they've gone up and they've gone down, they've been all over the place. And just like investing, you're going to experience a ton more throughout your life, right? Because even when you're in retirement, interest rates are still going to go up and down. So what's best is to build your balance sheet so that interest rates don't affect you in such a crazy way. The 80s were known as a like the boom for bonds. And that's because the interest rates on bonds were so high that people were just putting their money in government bonds and they were getting paid out 6, 7, 8, sometimes in the double digits interest rates. And they were able to live on that, right? $1 million, the bond was going to, if you put that all in bonds and the bond was at a 6% interest rate, it was paying you 60 grand. That's kind of cool, right? That's not the case as it's been in the last couple of decades. And while it might go back up to that, it's not something you don't want to count on. So here's what you should consider doing. Make sure you've got at least 3 different styles of buckets. We've had this conversation before in the past, and we want to make sure we've got one bucket for short-term use, right? This is your emergency fund. This is funds that you plan on possibly using. Maybe you're looking to buy a house in the near future, right? You want to have that sitting typically in an account that doesn't have a lot of risk, because when you find the house, you don't want the money to be down at the same time you need to use it to buy the house, right? So make sure you've got that short-term bucket. Alex and I always talk about it's best to have, at least a minimum of 3 months of your gross income sitting in a savings account. And that's for the emergency fund. We try to push people to more like 6 months, and that just creates flexibility. Okay. So that's bucket number one. Bucket number two is a bucket that often we don't see because it's skipped. And I think it's a misunderstanding of this bucket. And this bucket is a bucket where it might be just an investment account, right? And maybe it's low risk investment account. Maybe you're in treasuries or whatnot, but it's still a bucket that you can access, right? It's still liquid, right? And this is where we use to maybe buy other assets. Maybe you're putting money into this bucket. Maybe it's getting you 3, 4, 5%. And then maybe a asset comes out that you want to purchase. Could be real estate, could maybe even starting your own business. This is a bucket that creates that flexibility to do so. And it's a bucket you can use in retirement, by the way. You don't have to have a retirement account to retire. You can put all your money in an investment account. You may not want to, but it still is possible. Now, this investment account oftentimes is taxable. Now, if it's managed appropriately, you can get long-term capital gains tax rather than ordinary income tax, which is also called short-term capital gains, right? So that's your secondary bucket. Now, keep in mind what I've already just explained. The first two buckets, the key ingredient here is liquidity, meaning access to the money. Then there's the third bucket. The third bucket is retirement accounts. This is money that you don't plan on touching until you no longer want to work or have to work. Okay. This could be your traditional 401ks, your traditional IRAs, or Roth 401ks or Roth IRAs. That money is set aside for retirement. Typically can't touch it till you age 59 and a half, or you pay penalties, tax ramifications if it's in a tax deferred, or if you pull the money out too early, right? So this is 3 different buckets of money that you can use. And imagine having all 3 of these buckets throughout time, by the way. Like, these buckets should always be there. Because let's play this game. So let's just say you're in your mid 40s, getting close to 50. Not a lot's going to change until you retire, right? You might have some college funding for your kids, but everything's kind of set up in such a way. So maybe you're thinking about dialing back on one of these buckets. That's a question we get all the time. You may not want to do that, because when you get to retirement, wouldn't it be nice to have different buckets that are taxed differently? Tax deferred, tax free, maybe long-term capital gains, the flexibility of turning on income streams and mitigating the tax ramifications and mitigating volatility. Right? Everyone talks about, well, when you get to retirement, you shouldn't be as aggressive. Okay, how are you actually paring that back? What's your actual strategy? Like, if you're in a 90-10 strategy, 90% stocks, 10% bonds, what's your actual strategy to pare that back as you get closer to retirement? Right? It's easier said than done, but when you have these different buckets, it's already being done for you, which allows ultimate flexibility where interest rates don't affect you. Hopefully volatility don't affect you as much. That way, when you want to retire, if the market's down, it doesn't stop you from retiring, which I think most people want. So the end takeaway from today's episode is, look, the interest rates are going to go up and down. Yes, they just lowered. It's probably good news, especially from the real estate standpoint. But again, it's going to take some time, and we don't know exactly what's going to occur, which is why we want to make sure we've got a balance sheet set up to withstand everything that's going to happen in your life, not for the next 6 months or 12 months. So I hope this episode was valuable for you. Head over to beerandmoney.net, and there's a spot at the top of the page for you to contact us if you have any questions or concerns about today's episode, or maybe you've got a question or a concern that we haven't spoken about. It's a great way to reach us. Look, we started this podcast to help families build wealth so that you can actually spend time with your family and not stress about money. So I hope this episode is valuable. I hope this is helpful and maybe lowering some stress. And as always, cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Number 7067667.1. Expiration September 2026.